When you deposit money in a bank, you usually assume it is just sitting there, safe and ready. But banks lend, invest, and operate businesses with that money. So how can your savings still feel safe? The answer in many countries is deposit insurance. In the United States, it is most often called Fdic insurance. Today, let us slowly unpack what it actually does and what it does not. Deposit insurance is a guarantee, backed by a special agency, that promises to repay depositors up to a certain amount if their bank fails. In the United States, that agency is the Federal Deposit Insurance Corporation, often shortened to Fdic. Other countries have their own equivalents, often using similar designs. The basic idea is the same. Even if a bank collapses, ordinary depositors should not lose their everyday savings. Why does this exist? Because history showed how dangerous bank panics can be. When people lose trust in banks, they all rush to withdraw at once. Even healthy banks can collapse under that pressure, because they do not keep every deposit in a vault. Deposit insurance was created to break this fear cycle and to keep the financial system more stable for everyone, not only big institutions. Here is how the protection generally works in the United States. The Fdic insures eligible deposits at member banks, up to a set limit per depositor, per insured bank, per ownership category. So one person, with one type of account, at one insured bank, is protected up to that limit. That structure may sound technical, but each piece is designed to handle real, varied situations. Let us look at simple examples. If you have one personal checking account at one insured bank, your eligible balance is protected up to the standard limit. If you also have a savings account at the same bank in your own name, those balances may be added together for the same limit. That is because they often fall under the same ownership category for insurance purposes. Now imagine you also have a joint account with your spouse at the same bank. Joint accounts are generally treated as a separate ownership category, so coverage may be calculated differently for that joint account. This is why two careful people, with several legitimate ownership categories, can sometimes hold more than the basic limit at one bank and still be fully covered when properly structured. What about people who want even more coverage? One simple option is to spread money across multiple insured banks. The protection limit is per insured bank, so different banks usually mean different protection pools. This is why some savers with larger balances quietly use several banks. The goal is not to chase the highest interest rate, but to keep eligible deposits within insured limits at each one. It is also important to know what kinds of deposits are covered. Generally, checking accounts, savings accounts, money market deposit accounts, and certain certificates of deposit are within the protection. They are simple deposit products held at insured banks. The exact list can vary, but the spirit is consistent. The protection is meant for traditional bank deposits, not for every product a bank may sell. What is usually not covered is just as important. Investments held through the bank, like stocks, bonds, mutual funds, and most market-based products, are generally not covered by deposit insurance. They have their own separate rules and protections. Cryptocurrencies are usually not deposit insured either. So even at an insured bank, not every product on the shelf has the same kind of safety net. Another common confusion is about the institution itself. Deposit insurance only applies at insured banks. Some financial businesses are not insured banks at all. They may look modern and friendly, but if your money is held with a partner that is not an insured bank, the protection rules can be very different. Always check whether the actual holder of your funds is an insured institution. What happens when an insured bank actually fails? The Fdic steps in quickly, often over a weekend. The goal is to keep customer disruption small. Sometimes another bank takes over the failed bank's deposits, and accounts continue almost normally. Other times, the Fdic pays insured depositors directly. In either path, eligible deposits within the limit are protected, even if the original bank is gone. There can be a careful exception around uninsured amounts. If a depositor has more than the protected limit at one bank in one ownership category, the extra portion may not be fully recovered. Sometimes part of that extra is repaid as the bank's remaining assets are sold. But the safe assumption is to plan ahead so you are never relying on luck for amounts above the protection limit. A practical habit is to know your numbers. Keep a quiet mental note of how much you actually hold at each insured bank, and which ownership categories those balances fall under. For most people with normal household savings, this is rarely a concern. But for someone who is selling a home, receiving a settlement, or holding a large emergency fund, careful structuring really matters. You should also know how to verify a bank is actually insured. Most insured banks proudly display their status on signs, on websites, and in account documents. There are also official tools to look up institutions. A few minutes of checking can save real worry later. If a bank cannot clearly show its insured status, that alone is a reason to slow down and ask more questions. Deposit insurance is not magic. It does not protect you from poor investment decisions. It does not protect you from scams that move your money out of the insured bank. It does not protect you from inflation slowly reducing the buying power of your savings. It is one specific safety net for one specific risk. Knowing its boundaries is just as important as knowing its strength. For most everyday savers, the practical takeaway is simple. Keep your emergency fund and main savings at insured banks. Stay within the per bank, per ownership category limits. Know which products are deposit insured and which are not. If your situation grows more complex, learn about ownership categories or speak with a qualified professional. The system is robust, but it works best when you understand it. There is also a quieter benefit to all of this. Knowing your savings are protected lets you focus on bigger questions, like building your emergency fund, choosing investments thoughtfully, and planning for the long term. Deposit insurance is part of the foundation. When the foundation is solid, the rest of your financial life feels lighter, calmer, and easier to think about clearly. So here is the short version. Deposit insurance protects eligible deposits at insured banks, up to set limits, per depositor and per ownership category. It does not cover investments, scams, or losses from your own decisions. Understand which products and institutions are covered, and you turn what feels like trust in a bank into something more grounded. A clear, structured promise you can actually rely on.